In the last 2 decades, Netflix has transformed from a DVD rental startup to a Nasdaq-listed company with a $150 billion market cap. Founded in California in 1997 by Reed Hastings and Marc Randolph, the company is currently the world's most successful streaming service. They now have over 150 million subscribers around the world, including 60 million in the US, and are available almost worldwide apart from mainland China, Syria, North Korea and Crimea. They started their streaming business in 2007 and made the move to content production in 2012, debuting with their first series, Lilyhammer. Recently, however, they have received some criticism for the speed at which they have been burning through investors' cash. These funds needed, of course, to amass and produce from scratch the huge number of TV shows and films it needs to bring in and keep hold of subscribers. The company's annual program budget stands at $15 billion, and they have to date amassed a total of $42 billion of debt and longer-term payments related to content. Of course, they are not the only tech unicorn to be making substantial losses. Uber has been criticized on this aspect following its rocky debut on the stock market last month. Amazon also have delivered years of losses. However, unlike Uber, they were generating enough cash to support their phenomenal growth. A big problem for Netflix has been other arrivals on the streaming market, including Disney, Amazon and Apple, who are all intent on building rival services with their own original content. Also now, moves around the world will further increase competition, with Silvio Berlusconi's company Mediaset last week announcing a stake in ProSiebenSat.1, Germany's largest commercial broadcaster, in what is seen to be the first step to create a European competitor to Netflix. As these threats grow, Netflix is paying billions of dollars to build its own catalogue of original content programmes, such as Narcos, The Ozarks and The Crown. Thankfully, the large volumes of shows that it makes means that its fortunes do not rest on the success or failure of one particular series. Creating all this content requires constant funding, the bulk of which appears to be coming from the debt markets, with bond investors putting up $2 billion in April. In comparison, Disney is able to fund its own expansion, something that Netflix hopes to be able to do in the near future. However, for this to become a reality, it will require that subscribers are not lured away from the platform by its growing ranks of competitors. Rising subscriber numbers have led to a rise in Netflix's share price, up more than 30% this year. What it needs now is an increase in cash flow. This, of course, could have been the deciding factor in the recent subscription price raise. As Disney prepares to launch their rival streaming service later this year, they have stated that their price will start out as half that of Netflix's. Disney has already pulled its content from Netflix, and for those still looking to license their content, the prices have soared. Netflix will clearly need to keep its pricing low to stay competitive. One way around the problem could be the introduction of advertising. However, founder Reed Hastings has always been against the idea. Sir Martin Sorrell, the former head of the world's largest marketing group, WPP, has stated that Netflix will have to consider advertising as an alternative revenue generation opportunity. And it looks like there will be some investors who couldn't agree more.